Hello and welcome to Housing Joint Venture Module Number 2. Housing Joint Venture is the premier real estate impact investing firm that is committed to providing affordable housing to communities that need it the most. In this module, we will focus on real estate as an investment. As you may remember, in Module Number 1, we discussed the current housing market and the need for affordable rental housing at all income levels. This module will focus more on the specifics for methods to purchase and evaluate rental real estate. Income property investors expect to hold a property for a number of years. Remember, we're buying it for that year-over-year annualized income and the long-term building of wealth. An investment is a commitment of money, time, and effort. There are a number of methods to purchase property. Some of them include purchasing it with cash outright, using a mortgage at a standard interest rate, using personal or unsecured debt, using short-term or high interest rate debt, or seller finance payments. There are 4 facets that make an rental real estate particularly attractive. This is what makes real estate, as we call, a multi-dimensional asset class. These dimensions are the cash flow, the growth in value, the ability to serve as a tax shelter, and loan amortization. More specifically, the cash flow is the cash in from rental payments minus the cash that flows out. That net left over is called the cash flow. Growth in value is the difference between what you pay for an asset and what you're able to sell it for. An apartment building, for example, might grow in value because it has an income stream increase. Tax shelter. A tax shelter is a reduction or a deferral of a tax liability. It's an advantage of an income-producing property. Because you're able to deduct your operating expenses, mortgage interest, and depreciation. This is a non-cash item. Finally, loan amortization. This is the reduction of your mortgage balance that is typically paid by the monthly rent revenue. Again, the combination of these 4 facets is really what sets real estate apart as a superior asset class for investing. We will now review a number of different rates of return and other cash flow options to determine how you should best evaluate rental property so that you can determine what financial metrics will be more important for you as you create your own investment criteria. The first one is ROI, otherwise known as return on investment. This evaluates the efficiency of an investment compared to a number of other investments. It allows you to compare investments in what is thought of as an apples-to-apples comparison. Cash on cash return. This formula is the net operating income, otherwise known as your income minus expenses, minus the mortgage payment, divided by any cash that was invested in the property. This can be thought of as a down payment plus any financing cost of the loan. And don't forget your closing costs. The cash on cash return is really thinking about how much investment you're getting as a result of the cash that you're putting into the deal. So how much return are you getting on the actual cash that you as the investor had to place in that investment? Reserves. Reserves are liquid assets held by a bank, company, or government in order to meet the expected future payments and/or any emergency needs. Cash flow. In accounting, cash flow is the difference in the amount of cash available at the beginning of a period, otherwise known as opening balance, and the amount at the end of the period, also known as the closing balance. This is called positive if the cash balance is higher than the opening balance. If it's not, then it is a negative cash flow. Security deposit. Security deposit is a sum of money that is held in trust. It is either as an initial partial payment in the purchasing process, which can be known as earnest money or an earnest payment, or else in the course of a rental agreement. It is meant to ensure that the property owner against any default by the tenant. and for the cost of any repairs that occur in relation to damage explicitly specified in the lease and that it actually did in fact occur. Equity and non-equity investments. This is used to determine if your investment is debt versus equity. You may use either of these modalities to complete an investment, and it again must align with your specific investment criteria. So, what makes real estate an attractive investment option? We will go through a list of ideas to consider when determining your own investment criteria. Time horizon. It's important to think about how long you want to hold on to this investment and how long that equates with your specific goals. Return desired. Again, what is the rate of return that you need in order to meet your investment goals? As mentioned previously, you may use general return on investment or cash-on-cash return as two example metrics to use to determine that return that the investment will make. Source of funds. The source of funds may either come from cash or tax-advantaged accounts. And finally, your risk profile. This is exposure that you may have to additional capital contributions. So how do you determine and forecast a property's income stream? You begin by collecting market data. You then use that data to dive down into one level deeper and determine a property assessment. This is known as your due diligence. This is really where the rubber hits the road and you're able to really evaluate if this property is a good fit or not for your specific goals and investment portfolio. A profit and loss statement may also be used, again, as a way to determine how well this property is going to cash flow and if the profit that is able to gain or any losses incurred as a result of operating expenses, if this property will fit into your overall investment portfolio. We want to build cash flow and resale and use a pro forma to determine what those metrics are. Market data. Market data is provided by commercial real estate brokers, commercial appraisers, census data, third-party vendors such as LoopNet or Esri and their associated reports. There are a number of different sources of market data that we may look for. For example, lease rates for various property types. Different properties may command different rental amounts. For example, a single-family home may rent for a higher amount than an apartment unit, even though it may have the similar number of bedrooms and bathrooms. Capitalization rate. A capitalization rate is used to determine what is the overall investment return that you will get. A capitalization rate takes the annual net operating income over an annualized amount and allows you to determine what is the capitalization or how far is my money going to give me every year in terms of a return. Competition for tenants. The market can change up and down, and there's different competitions for tenants. Sometimes there is a flux, meaning that there are more available tenants than available properties. At this time, you'll have your selection of tenants and can drive rental rates higher. Alternatively, when there's a shortage of tenants, then property owners are encouraged to reduce their rental amounts in order to encourage persons to consider their property as their home. Vacancy rates. Vacancy rates may differ based on different property types. Terms of available financing. Items such as underwriting, down payment required, and mortgage rates will all determine the terms of available financing, and this will be market specific. Employment trends. Real estate and real estate trends are a secondary market, and they tend to follow employment trends. If employment and available jobs are increasing, then so will the demand for housing. So too, if deployment is decreasing and there is not a need for workers in the area, then the demand for housing will also decrease. Property tax trends. Municipal budget issues. Of course, government and government concerns can influence your properties, not only in terms of the property taxes and the rates that you will be charged on an annual basis, but also budgeting issues. These can, in turn, filter down to your annual property taxes and have an effect on your monthly and annual cash flow. And of course, the general business climate. How friendly the market is for business in general is going to affect both the overall market and the performance of an individual property. And then finally, the state of the local economy. Property-related data can come directly from the owner, a broker, or a listing agent. Property-related data can include items such as property taxes, property insurance rates, utility costs, operating expenses, lease contracts, occupancy and payment history, maintenance records, property management contacts and associated costs and fees, the history of improvements to that property, including invoices, contracts, and permits, an estimate of all potential costs. So, using this information, you can determine, are you ready to invest? We want to take this moment to have a note on investing responsibly. There are a number of financial terminologies that we did not discuss previously that we want to take the time to review at this time. Gross scheduled income. Gross scheduled income, otherwise known as the GSI, is the total annual rent value for all rental income. This does not include potential vacancy rates. This indeed is the best case scenario. A vacancy allowance is the estimated amount of potential income that will be lost due to a vacancy. Gross operating income is the amount that you actually collect. That is, your gross scheduled income, or your GSI, minus your vacancy adjustment, VA, is the gross operating income, or GOI. Operating expenses. Operating expenses are necessary for the maintenance of the property and ensures that its continued ability to produce its income. Net operating income. Net operating income is what's left over of the total potential income after all the vacancy and expense items have been paid. Income capitalization. Income capitalization is estimating the value of an income property to divide it by the NOI by the cap rates for similar properties. It allows you to compare property to property, again, as an apples-to-apples comparison. The annual property operating data, otherwise known as APOD, is how you're able to build a profit and loss statement for an income property. What you're able to do is look at the income, subtract your reserves, and account for a management fee. A management fee will depend on the locality, but typically ranges from 7 to 9%. Additional items to consider are owner's profit. Owner's profit typically ranges from 2 to 5%, property repair and maintenance services, which obviously are about 20%, and of course, property management. So these are going to be the ongoing expenses associated with property management over and above the property management fees. Again, about 20%. It is important to recognize that there are different classes of investors, accredited and non-accredited. An investor who does not meet the net worth requirements for an accredited investor, as noted by the Securities and Exchange Commission's Regulation D, should be mindful. A non-accredited investor is an individual who has a net worth of less than $1 million, including their spouse, and who has earned less than $200,000 annually, $300,000 annually, including the spouse's income, over the last 2 years. When a company raises private equity for an investment, such as a new company or a hedge fund, it is able to receive unlimited investments from accredited investors. On the other hand, Regulation D, again from the SEC, stipulates that only 35 non-accredited investors are allowed to invest money into a private placement. Thank you again for your time and attention from module number 2. We hope that this module has helped you as you go on to determine your own investment criteria and the specifics for evaluating and purchasing rental real estate.